Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by Austral Asset Management. It's Thursday the 26th of January, and we have David Kuo, founder of the Smart Investor in Singapore, joining us as our regular Thursday guest. David, great to have you on the show as always.
Hey, selamat tengah hari, Brian.
Now, selamat tengah hari. I'm going to come back to you after we take a look at how regional markets have performed in the first half of the day. David, but we will start with how crypto markets are performing right now. Bitcoin has breached the 23,000 mark. It's at 23,175. It's up 2.33%. I just remember about 2 weeks ago, I think it was at 16,000. Now, Ethereum is at 1,617. It's up 4.61%. Now, looking across the regional equity markets, first of all, Chinese markets and Hong Kong and Australia are closed for holidays. So we start with the SGX. The SGX is up 0.43%. Bursa Malaysia is down 0.21%. The ASX All Ordinaries is shut today. The Nikkei is down 0.26%. And rounding up the numbers, we've got the Kospi, which is up 1.1%. David, your view on how markets have performed in the first half of the day and the reasons for that?
Okay, well, if you have a look, I mean, Hong Kong is an obvious standout. Hong Kong has been closed over the Chinese New Year break, and so it's a bit of revenge buying at the moment. So Hong Kong's doing a bit of catch up with the rest of the world, given how well the US market has been doing over the last few days. So a bit of revenge buying. Singapore had its revenge buying yesterday, and we saw a bit of revenge buying from KL yesterday, from the KLCI yesterday. But one question I do ask myself is, why are stock markets as resilient as they are? And of course, you pointed to how well Bitcoin has done fairly recently. And it looks pretty much as though risk assets are back in fashion again. And people are piling into most risk assets, not just the stock market, but also cryptocurrencies. But you have to ask yourself why. I mean, why are they doing that? Do they think that the coast is clear ahead? Do they think that everything is going to be fine? And do they think that maybe the Federal Reserve is going to start winding down its monetary tightening policies? I don't know. But all I do know, Brian, and this is something that I say to people all the time, regardless of what you are buying, look at the company today and then imagine yourself, transport yourself 10 years into the future and say, is this company, number one, still going to be around in 10 years' time? Has it got a good enough balance sheet to enable it to be sustainable in 10 years' time? And secondly, is it going to be bigger in 10 years' time compared to today? And if it is, then it's not a question of whether you go into risk assets or not. It's a question of whether or not that company is going to deliver for you over the 10 years. So that's my quick take on what the stock market mentality should be if you're going to be buying shares.
Now, just on that theme, David, we've got to then talk about tech companies, because that's really using your litmus test. That's actually a good barometer in terms of thinking about whether companies are going to be around and whether the balance sheets are strong enough. We have an old name, IBM, that just announced that it's laying off 3,900 jobs, or 1.5% of its workforce. That's an old name that's still around. That revenues were flat and not declining as was predicted by Wall Street. What's your view on the recent tech layoffs, and what does that signal to us, the outlook for the global economy?
Okay, well, there are two things. First of all, when you have a look at IBM, the results weren't really that bad. I mean, they are generating cash flow. And so if your litmus test is whether or not a company is capable of delivering cash flow and free cash flow, then I would say, IBM fits that bill. Is IBM going to shock and awe in terms of growth? I don't think it is. It's just a nice, steady performer. So if you like a company that just plods along over time, a bit like the Unilevers of the consumer world, then that's fine. I mean, IBM will tick that box for you. What IBM is signaling, however, is that they are going to be making some job cuts. And it's only 1.5% of its workforce, which really isn't sort of that big a deal. But when you take a look at it in aggregate, it's not just IBM. Microsoft announced that it was going to be cutting jobs. Salesforce is cutting jobs. And a load of the other companies are also cutting jobs. So what they're actually telling you is that they are taking some measures now to ensure that, number one, they will be there in 10 years' time. If you are invested in these companies, then you know that the company is doing the right thing. The ones that aren't doing the right things are the ones that are shutting their eyes, sticking their fingers in their ears and saying, la, 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 I don't want to hear what's going on. And those are the ones that you should be worried about. So I'm pretty confident that the likes of IBM, Microsoft, Salesforce, all of these companies will be around in 10 years' time. And if you are invested in these companies, don't be too surprised, if the share price is a bit on the volatile side, but the companies are doing the right thing. And what they're saying is that they don't think 2023 is going to be that great a year for them. So they're battening down the hatches a bit, hunkering down, and making sure they have enough cash to invest in the parts of the business that will be able to grow for you over the next decade.
Now, speaking of expectations of a slowdown, we've got some backward-looking numbers coming up shortly. The Q4 GDP numbers out of the US, Q1, Q2, Q3 were pretty good. What is the expectation for Q4?
Well, I think a lot of people will be focusing on these Q4 numbers because I think it is going to indicate a slowdown from the third quarter. So, but it doesn't actually sort of mean that the US economy is shrinking. It just means that it won't be as robust as it was in the third quarter of 2022. That will actually please, to some extent, the people over at the Federal Reserve, because they want to see a gradual slowdown in the economy, but at the same time, they don't want to see a complete slowdown or a reversal of expansion. So maybe the Federal Reserve is doing the right things at the moment. Maybe their rate hikes are achieving what they want to achieve, which is to ensure that inflation is coming down at a steady pace without causing economic shocks to the American economy. A lot of people said that a soft landing was going to be almost impossible, but maybe Jay Powell has got the magic touch. Maybe he is going to be able to achieve that soft landing. But at the same time, we go back to what these tech companies are saying, which is that even though the economy may be going through or achieving some kind of soft landing, they're saying, I got to look after my business. So the economy is one thing, the company is another. And that is something that people also need to be aware of. A group of companies make an economy, but within that group of companies, some of them will be strong, some of them will be weak. So you can't just look at the economic numbers and say, oh, the economy is slowing down, therefore I mustn't invest. That is the wrong attitude to take. The economy is slowing down, but you must still invest in good companies. And that has always been my mantra from the day I started investing, Brian.
Now, David, speaking of the Fed, the bank, but then on the other side of the equation, Bank of Canada is signaling an end to aggressive monetary tightening. Is that a bellwether then for the Fed to signal perhaps it's going to pull back much earlier than expected?
Well, when you take a look at two very important numbers, the first one is the interest rate that the bank of whichever central bank is imposing at the moment, and the inflation rate. And there are vast similarities between America and Canada. In both cases, you actually see that the interest rates are around about 4.5%. The inflation rate is roughly about 6.5%. So what the Bank of Canada is saying, maybe its job is more or less done at the moment, but I don't think it is, because the interest rate must be above the inflation rate to keep a lid on inflation. So maybe it thinks that inflation will start to moderate over time, and therefore it doesn't need to be as aggressive. But the elephant in the room, Brian, isn't interest rates. It's quantitative tightening. What the Bank of Canada also said was that it will continue with quantitative tightening, which means that it will continue to withdraw liquidity from the market, even though it might not increase interest rates as aggressively. But I think It doesn't mean that it won't increase interest rates. It just means that it won't be increasing interest rates as aggressively. And I think this is the same path that maybe the Federal Reserve will be taking. And so maybe you're right. The Bank of Canada could be a kind of barometer for what the Federal Reserve will be doing.
Now, David, as always, a fascinating conversation. Thank you very much for your insights.
Thank you.
We've been speaking to David Kuo, founder of the Smart Investor in Singapore, on BizTech's Asian Midday Market Watch, powered by Austral Asset Management. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.